All right, good afternoon, everybody. Chris Lester here. For those of you that are new to the call, it's been just about a year now that COVID hit. I elected to start a weekly call like this. And not only is the call for me, my clients, my relationships, but sometimes some of our advisors that I work with belong to a group called the Eagle Team. And we're a like minded group. I'm one of the partners. And quite often I will have them invite their clients onto the call because nothing's going to be sold here, right? We're not trying to sell you anything. This is purely an educational format to just give you a perspective of things that maybe quite often are overlooked. At 30 years as a financial advisor, I've run across a lot of scenarios. And one of the biggest ones is just helping people to understand the landscapes and to not let emotions rule their decisions. So a couple things I want to just touch base on before I get started in today's call. I have introduced our RIA, which is now Brookstone has merged with Formula Folios, their philosophy, which is a core philosophy, risk appropriate investment philosophy, and then satellites that you can add to that philosophy. I had said that this week and next week I would talk about some of those satellites, but in the spirit of keeping pace with our monthly market update, January will fast get away from us. So I wanted to just touch base, interject the January market recap, just sort of signals that we're seeing in the market. And then next week, I actually spoke with Mark DiOrio, who's the Chief Investment Officer. Also, he's a certified financial analyst. He's in charge of a lot of the investment philosophies and strategies. He's going to join us on the call next week. And we're going to probably, over the next 2 weeks, do two separate calls. Next week, we'll be on structured notes, how they're working. I will tell you this, because I was in Florida last week. I met with Mark, met with the president of Brookstone. And I was really impressed to hear that they had secured the note for March in just a very simplified fashion. Think of a structured note as a fixed index in the insurance world, a bank's version of that. So these are predetermined rules and guidelines. Well, the terms that they negotiated for the March note, which is a 12-month note, is actually in excess of 13%. You're not putting all your money into that note, but you will structure it and ladder it over the course of a year. And so if you want to learn more about that opportunity in a world of extreme volatility, also you're going to see me talk here today a little bit about the hunt for yield. It is absolutely a great bond alternative and we should consider. So without further ado, let's talk about growth markets in January. So this is a monthly recap of equity indexes. And we're going to start from left to right, right? So we have at the upper left-hand corner, we have the indexes. We have the S&P 500, which is market cap weighted. Most of us are familiar with the S&P. That's US-based equities. Then the blue is the Russell, which is small caps. So those are, your small businesses that we're trying to help keep their doors open, maybe ordering a little bit takeout food, gymnasiums, restaurants, some of these smaller companies. And then you have developed countries, right? So your European countries, usually that's their equity markets overseas. And then you have emerging growth. I usually refer to this as typically, China and maybe lesser known countries that corporations are looking to expand. Then you see commodities, which has been challenged of late. We have real estate and then gold. So as we look at this chart, and it's a spaghetti pattern, if you recall from last year, we started to see this consistent month after month left to right growth. But now you see a little bit more, I would think on a monthly basis, a little bit more of a choppy pattern. Now, small caps, the Russell 2000 wins the day for the month of January. And that is, to be expected right now because I think a lot of people are trying to help out the smaller companies. We've talked about in the past putting too much weight, and that's why when you see on TV, you see, the S&P is at all-time highs or the Dow's at all-time highs. Quite often we believe in more of a broader-based investment philosophy versus just picking the S&P as your equity portfolio. Next, the second best was commodities. And that is welcome news because commodities last year got their clocks cleaned. And the reason is because most of the index here is primarily or predominantly oil related. Actually, the forecast going forward is it looks like a lot of the travel industry is starting to get a little glimmer of hope. That would mean that, hey, oil, which has been in an abundance of recent times, will start to get utilized. So that's why you're seeing growth in that arena. And then now we see emerging growth. So that's China, typically. They seem to have had a good month there as well. And then the next three indices. So real estate is pretty much a sideways pattern. One of the things I noticed about real estate, I had a client that I was speaking to today, and they were talking about, hey, listen, part of my long-term plan is maybe buying a second home, whatever. I'm never here to tell you yes or no, but just take things into consideration. I just look at in my surrounding area when I'm talking to folks, right? So my next door neighbor last year sold their house in literally, I think it was on the market and gone in a day. I'm hearing story after story of where people are moving out of New York. We're here in New Jersey. So they're moving out of New York in these big cities, and they're going to these rural areas. And they are absolutely putting cash down. They're buying property at above asking price. And so typically this black line is real estate is typically like real estate investment trust. So I would be cautious investing overall in REITs or anything that's real estate investment related, because right now I think that a lot of strip malls, a lot of office buildings are going to be challenged. I think our future going forward will be not like we were accustomed to. Going into the office, going into New York, any of these places that were renting spaces are now learning how to operate and function in a virtual arena. So this is just 1 month. But just keep in mind, if you're looking at property, be patient. You want to buy property when it's 2009, right? When all the dust has settled, and you say, now you want to step in. If you want to be a land baron, if you want to own property, give that some consideration and be patient. The next one is developed European countries, and that's off a little bit, as well as the month of January for the S&P. And that's where, remember that the S&P index is at all-time highs. Now, that being said, it's really being carried by 5 stocks right now. So, you got to just think that, just as much as I believe in betting on the US and I want you exposed to equities, I would not have all my eggs in a market cap weighted index like the S&P, probably too heavily weighted. I would be cautious. And then lastly, notice that for the first time in a while, gold, who was finishing top of the charts month after month last year, actually had a negative return. And that is because people now are starting to think, is the equity arena a better value going forward? So now what's going to be interesting, I'm going to change slides. We're going to go from January to the year to date. Well, guess what? We've only had 1 month. So this slide is exactly the same. There's no difference. That's why I took a little longer to go through the recap, because right now, January, year to date versus month to date will be identical. But next month, we will start to see a little bit more of an accurate picture from a macro view. We talk about this index, and I will point out to you something that I've mentioned in the past. And for those of you that have not seen it, it's called the bull bear indicator. It's just a chart. It's just data that our research team uses. And it's using trigger points. At the top, it's your relative strength index. Then you have your moving averages, and then you have your MACD, right? So these are just triggers. And what happens on this chart is if all 3 of those signals, right, cross over or turn negative, it will turn to a red line. So if you look here all the way to the left, back in 2000, when the internet bubble burst, all 3 indicators went left, are negative, and we had a downward trend, of which we remember if you were around back then and invested in the market. And then it tripped green, and we had an upward trend. And then we had a head fake here, right? So you had, it was supposed to go down, but then the signals entered to get back into the market, and still an upward trend until 2008, which was the housing bubble burst. It tripped, right? All 3 signals went south. And we had a negative run for about 18 months. And then it finally turned positive. You can't perfectly time it, because the signals didn't turn positive until almost 6 months after the bottom. And so you could have missed some of the upward trends. So you can't be a Monday day quarterback. You have to have strategies and philosophy. And remember, this is just one index, which is the S&P. But now we fast forward, and one of the things I just want to show you is that this right here, this divergence, right? There's not a crossover to see. Now, this is what happened. This is COVID right here. COVID hit, and we talked to a lot of our clients, and we said we think, and all the signals and a lot of the pundits think that this will turn around, and it turned around to be an accurate call. I don't have a crystal ball. So it's difficult to time the market, but we have to have strategies based on your goals and then implement a strategy regardless of that. And so that we don't want to lose money. Remember, Warren Buffett's rule number one to investing is don't lose money. And so when we're strategizing with clients, we want to just make sure that we're taking your specific goals into consideration and then developing a strategy that will surround that. Never do we want you laying in bed at night, staring at the ceiling going, oh my God, I just watched my life savings go out the window. And it's not necessary, but quite often, remember, the media thrives on news, good and bad. So they're always going to talk about the negative all-time highs or, oh my God, the market's turned south. I just real quickly just looked at my iPhone, and sure enough, there's news. Oh, the market's nervous about jobs data. And then tomorrow we'll say everything else is looking positive because it looks like unemployment wasn't as high as it was supposed to be. So there will always be these daily fluctuations, and we can't, get caught up in the noise. We just have to have strategies. And that's part of what I view my role as, is helping to manage the emotions, right? We're all human beings, and we tend to sometimes want to make knee-jerk reactions or be reactionary. And when it comes to investing, that has been proven time and time again not to be prudent. So we want to pick a strategy. And once we say, hey, I like that strategy, then we're going to figure out how to enter into the marketplace in a reasonable fashion. All right, so now let's go to the income market. So we're going to go again from the left to right. We're going to see we have our U.S. aggregate bond. So bonds are, remember, corporations. You're lending corporations money and with their promise to pay, and that's a corporate bond, right? So that's the U.S., and then the blue box is high yield corporate bond. Whenever I use the term high yield, I want you to substitute the word high yield for junk. So when you hear the word junk bond, understand they're going to pay above average rates of return or yield, but we also have more risk associated with that. Then the neon green here is the treasury bonds, 7 to 10 year. So those are intermediates. And then you have your Vanguard total international bonds. So these are developed countries overseas. And then you have your 20-year treasuries. You have your muni bonds. So you have your national, and then you have your high yield muni bonds, right? So these are all governmental, right? So they're municipals, but sometimes governments can take on some above average risk. Now notice, and I find this interesting, the number one performer is the high yield muni bond. So let's substitute high yield for junk. Now we're going to say junk governmental bonds, right? That's where, when I'm looking at municipalities that are engaging in risky lending, right? I'm just a little cautious, but it proves the point that I've been sharing for a couple months now. Think about this. The world is going to be in a hunt for yield. If you retired in 2008 and your portfolio, in order for you to be able to live comfortably, you needed a 6% rate of return on your portfolio, but your portfolio is now getting negative 1.2, that's a problem, right? So that was never anticipated. Remember, the 50-year average of bonds overall has been about 6%. And now we're down to 1% maybe? So that being said, is a problem for yield. And we have to start to think about bond alternatives or ways to generate or have yield come into the portfolio and diversify the risk. That's where just because it worked for the last 50 years one way, and again, Mark will touch base on this, and I've been talking about it on some of my one-on-ones with clients, but just understand that we need to strategize to make sure that we have a reasonable rate of return with reasonable amounts of risk to generate the type of income that we might need. So high yield munis won the day for the month. And then we went to traditional munis, right? So both municipal bonds in general, there was a flight in the month of January by investors that are seeking yield And these were the two highest seeking yield strategies. Then we went into negative territory, right? So bonds, which had been on an upward trend for the month of January, actually had negative returns. And that makes sense because the chairman is saying, hey, listen, there's probability that inflation will be coming. They're flooding the marketplace with treasuries. And so the appetite has just been flooded with the amount. So you see, remember, for the whole year, 7-year and 20-year treasuries was the flight to safety because they were able to pay. It was a hey, I don't want to lose money mentality. Let me buy these things and I got something. Well, now there's just so much of it. They've started to lose value. So just keep that in mind. And then we have high yield corporate bonds actually lost money, and that doesn't surprise me. Again, in the hunt for yield, now again, substitute the word junk, and we could start to see some above average. But not does 1 month does a cake get made. It's not panic. It's not that the sky is falling. This is just data for observation. We just have to be cognizant of understanding that the traditional philosophy of, say, a 60-40 blend or target date funds, I've talked about those before, right? That they can be extremely dangerous as we approach retirement because you put them on autopilot, you set the stage that they're safe, but yet what happens is that they automatically are dialing into a bond or a more heavily weighted bond dynamic. Yet remember, in past months, I've preached this for till the cows come home. Bonds do not like rising interest rates. You can lose money in bonds. Just think about it. And I go back to 2008, Vanguard had a 2010 target date fund that lost almost 30-40% 1 year before folks that were in that were going to retire. You have to be careful of target date funds because just because they're on automatic does not mean they're safe. They're sold to be safe, but they're not usually. And that just, regardless of whether it's a target date fund or if you're following traditional wisdom, which is, oh, when you're younger, you want to be 70 or 80% equities and 20 or 30% bonds. But as you approach retirement, you want to be 60, 70, 80% bonds and 20% equities. We are now finding that the entire landscape has changed. And that part of dealing with a professional and walking through this, and you'll see that we have data that is starting to suggest that the party's over. And what do I mean by that? I've said this time and time again, and I'll say it again because it's worth repeating. We are at the tail end of a secular bull bond market. So this next slide, but this is the same thing, bull bear aggregate bond market. So we've been on this upward trend. So bonds have been all the rave. And if you look at a 50-year chart, but what's starting to happen right here, see this last one here, the MACD, the moving average convergence divergence, this right here is starting to cross over. Now, doesn't mean panic, but it is one of the triggers that could take this green line and flip it red, right? So all three of these have to go, but they all look pretty close. So we're keeping our eyes on this on a regular basis. This is why I've been cautioning everybody about being overly weighted in bonds. They are a cause of concern. Now, this indicator right here, this is the Recession Probability Analytic. This is a proprietary forecasting tool that Formulafolios created and now is part of Brookstone's. And basically what it's doing is taking 100 data points. It's looking at what's housing starts, what's the gross domestic products, what are goods coming in, jobs data, all this data. And then it plots it out and it assigns a value between 0 and 100. And if you're at 0, it means that the economy is singing and hallelujah and high-fiving, and we're, the roaring 20s all over again, right? But if it goes to 100, that means the sky is falling and run for the hills, and you should be investing in guns and ammo. With that being said, the 50 percentile is the direction that things tend to lean. And so it's never going to be at 0 or 100, but it usually is going to be between that 80 and 20, right? So if it's above the line, that means, hey, be careful, because that means that we could be heading into a recession probability, right? But if it's below the line, then that means that things right now seem to be okay. And that is the continued message that we're giving to investors right now, at least for the next 6 months. All of our signals and the indicators that we're seeing are showing an upward trend, right? We think continued growth in the equities market, continued growth in the bonds market, but we think that come July, come August, we should reevaluate our portfolios, and that we should start to just say, hey, listen, you know what, let's reevaluate. So we're actually down, so the reading is down from 28.06 down from 28.74. It's a modest change. It's basically we're having a sideways movement. And just also see that, last year, right, when COVID hit, that fear sort of jumped out there, and we talked about it. And then it started, after a couple months of saying, hey, we're here, right? We're things are going okay. But then things started to trend down, and we said, you know what? And once it crossed over here, there was almost this pause or a sigh of relief in the economy. So, folks, I am at the end of my call. So I wanted to just real quickly, I want to thank everybody for taking time. I've missed you guys. I can't wait to see you all. Hug you, hug your necks. I hope everybody in your families are staying safe. This is not over anytime soon. We have to be diligent. And again, if you need me, I want you to go ahead. Please make sure you reach out to me. Here's my contact information. I'm always here to help. I've built my practice on helping folks. And if I can do anything for you, or if you have questions, if you were invited on this call by another advisor, please reach out and ask them the question. And if they don't know, ask me the question. I'm happy to help. So folks, great seeing you. Do not miss next week. It's going to be a treat. Mark DiOrio, great speaker, brilliant man, certified financial analyst, telling you how structured notes work. And like I said, I'm excited for the clients that have already started to step into the arena. The March notes that they originally had negotiated 10% because of the spike, because of volatility with GameStop stock caused a spike in the volatility. They were able to lock in 13%. So we'll explain more of that next week. If you know anybody that should be on this call next week, make sure that you invite them, and have a great day. Bye-bye.